Hey everyone, and welcome back. Crazy day today here. Wow. I mean, markets have been closed for almost 4 hours now, and I am still pretty shocked. But anyways, we'll go over it here real quick. So what we have in front of us is the core consumer price index year over year, and as we can see, the actual figure came in higher than the forecast, so 6.6, which is higher than 6.5, and the previous reading of 6.3. And of course, it's bad because that shows that inflation is not really peaking. Around this time, we thought it peaked, but now it's coming back. And this is the thing with inflation. Inflation comes and goes. It looks like it's fading, and then it comes back. It's like whack-a-mole. And this is a headache for central banks because if inflation doesn't come down, that means they have to raise interest rates. So that is now showing up in the Fed forecasts. This is the Fed rate monitor tool. I've shown you this before. And the previous day, we had about an 80% chance that there would be a 75-point basis hike. Now, this would be the fourth 75 basis point hike, which, a couple months ago, the Fed was saying that 75 basis points, we're not going to be hiking by that much. It's not happening. But now we are at our fourth rate hike soon of 75 basis points. But now, not only is that pretty much guaranteed to happen because there was like a 20% chance that it wasn't, but now we're even pricing in the possibility, very partially, it's just small, but we are pricing in 100 basis point hike. And that kind of just shows how worried people are about this inflation getting out of hand. And again, the Fed has to raise interest rates, but it seems that they're going to be raising rates even more than we anticipated before the year ends. And that's not just for the November 2nd meeting, which is our next one, but also our last one for the year on December 14th. We also have an increasing probability that we're going to have to raise rates even higher. We were thinking 50 basis points for December, now 75. So that is not good for stocks. And the initial reaction we had today was correct. As soon as the data came out, this was our previous close, we dropped a lot, like 100 handles, basically, right out the gate. But then we had this crazy rally. This was, I believe, the fifth largest intraday increase on record. So intraday just means during the trading session. So, and this was, again, I believe the fifth largest one on record. So, I mean, it was very impressive. It caught a lot of investors off guard, I know. And a lot of people that had basically kind of given up here, their fortunes reversed. And I mean, that's the stock market for you, okay? You have your ups and downs. And again, we never said that things go down in a straight line. Just the overall trend is still to downside, especially since the Fed is going to continue raising interest rates. But the reason why I'm showing this, because again, I know some people are thinking, okay, so if raising interest rates are bad, then why are you showing me this chart of the stock doing the complete opposite of what stocks should be doing, right? Especially since the inflation print came in much hotter than anticipated. Well, the point of me showing this again is that a lot of people are getting carried away by what they see in the stock market, okay? Some of you guys remember I talked about the bond market before. You would know that the bond market is very important, and looking at it provides you clues as to where the market is headed. So if you use that to your advantage, congratulations, you kind of dodged a bullet with everything else because markets have fallen more since then. But if we take a look here at what's going on exactly, the bond market is on pace for its worst year in history with a loss of 15.2%, which is 5 times larger than the previous worst year back in 1994, and they were only down by 2.9%. 2.9% was a bad year, but 15.2 is what we have so far this year. So we're not even done with this year yet, and we are already down by like a massive amount. So I know bond investors are having the time of their life right now. And for those of you that came in just recently into the trade, well, good luck. Because it has been rough out there. And as we can see with the TLT, which is the bond ETF. Well, this is about where we started this year. Yeah, this candle. So we were around 140s, and I mean, it has been quite the fall. I believe the first time I made the video on TLT, we were around here. And since then, we have gone even further down. We are actually now below 100, which is a very symbolic number, of course. But it is the lowest since 2011. Yes, I mean, we are literally being thrown back in time here. And the lower this goes, the worse this is for the stock market by multitudes. Because again, as I've said before, and please check out my videos on the bond market and yields. It'll provide you a lot more context, and you'll appreciate this much more. But again, the bond market is way more significant and way larger than the stock market. If you have problems in the bond market, you're going to have problems in the stock market, which is why you can use the bond market or TLT here as an indicator of what to expect. And so, like, for example, today we had this massive rally, right? But then if you actually take a look at TLT, sure, we had an initial bounce out of the 98 zone, and then we came to the 99s, briefly pierced through 100, but then settled back in the 99 range. So we didn't really have that follow through as compared with the S&P 500 here, which had a massive day. So you can look at that and think to yourself, well, okay, the stock market rallied, but the bond market didn't really follow. In fact, we kind of went down pretty much at the end of the day. So what does that tell you? That tells you that it's a false flag. Don't pay attention to the stock market because we are not going anywhere without the bond market. And currently the bond market, it's not feeling that optimistic. So that is what you need to understand. The bond market, way more important. If we take a look at the 10-year yield, again, this drop in the bond market is substantial. And I mean, the spike in bond yields. So again, bond prices and bond yields are inversely related. If bond yields are spiking like this means that people are selling out of bonds at a rapid pace and the price keeps going down. This is the fastest set of rate hikes we've seen in history. I mean, we've never raised this much this fast ever. And that is being reflected here in the 10-year yield. And of course, there are other bond durations out there. So again, pay attention to what is happening in the bond market. Do not get carried away with this day-to-day action in the stock market. Always use the TLT or whatever bond ETF you favor. Use that to your advantage because it will show you the light. Okay. Now, on a side note, I want to talk about the dollar because the dollar is also important here. If you have yields going up or bond prices going down alongside an increasing dollar, that is the most potent mix you can have to cause a stock market crash. And what we have are extreme examples to the upside of both, right? So we just saw what happened with yields, and we're seeing what's happening with the dollar. Now, the dollar index, again, it's a basket. A basket of the dollar being compared with other currencies. That includes the euro, the yen, the British pound, etc., etc. And as we can see here, the higher this dollar index goes, that means other currencies around the globe are devaluing, and by the looks of it, at a very rapid pace. So for example, let's take a look here at the Japanese yen. I have actually shown this in a previous video. I do remember. And at that time, I had said that if the dollar continues to strengthen and, the yen will continue to devalue, and the Asian financial crisis, which happened a while ago, around 1997, that really caused the yen to spike, as we can see here, and the highest it went was about 144. The level to be really worried about here is about 150. Okay, I mean, we're already in danger zone right now. It's really bad. But if the yen devalues to 150 against the US dollar, Very, very big red flag. Some other red flags to look at is the British pound, which is at pretty much its lowest level since 85, and if it goes down below that, it will be at new records. So the British pound is also suffering immensely, and then also the euro. The euro, although not as bad as the British pound, is falling rapidly. The level you probably want to anticipate for the euro to the dollar is 0.90. Now, again, you don't really need to look at these like one by one very specifically. I'm just showing, just in case you're interested, in diving a little deeper on what is causing the dollar index to move up so rapidly. And it's because these currencies are devaluing very quickly against the dollar. And all currencies are pegged to the dollar because dollar is still considered like gold, even though it's not. But it's considered the reserve currency. So it's the central standard currency, and all other currencies are connected to it. Therefore, if they devalue against the dollar, that makes the dollar stronger, and we spike. So again, that is, again, just something else to keep in mind here. You obviously take a look at the bond market, what's happening there, but keep track of what's happening with the dollar too, because not only is this important for your investing, this is also important for, if you're like traveling, for instance. So let's take Japan, for example, okay? Japan, like a lot of people are wanting to go to Japan right now because the dollar is very, very strong compared to the yen, right? So, just earlier this year, you were at 115. So $1 got you about 115 yen. So that was the exchange rate. Now, $1 gets you 147 yen. That is like what, a 28% increase, like 28 to 30% increase. It's absolutely wild, but that is what we're seeing. So a lot of people are trying to go to Japan and other countries. Europe's also one, right? Because the euro is devaluing. So, in terms of travel for Americans with dollars or just anybody with dollars, this is great, right? But again, you have to understand Forex to understand that these are things to take advantage of. So anyways, again, that's just my point about it's not only about markets, but just your overall understanding of finance. It's good to know these things. That is it for me. If you guys have any questions or comments, feel free to reach out. Please like, share, and subscribe, and I'll see you all in the next one.